In this video, I will give you the 10 steps that you can take to find the perfect trade every single time. And we're going to take a look at the perfect entry. How do you find the right charts? What does the perfect trade look like? How do you develop the exit plan? Where do you place the right stop loss, the perfect target? How do you scale out of your trades? How do you align the higher and the lower time frame so that they work together nicely? We're also going to take a look at the mental side. How do you prepare? And everything that needs to go into finding the perfect trade every single time. So I've been trading for over 14 years, and the first thing that I always do is when I pull up a chart is that I ask myself, are we in a trending market or are we in a ranging market? This is very important because you need to have a chart and you need to trade charts that are in line with your trading strategy. So I consider myself a trend trader. I need to find markets that exhibit trending characteristics, otherwise my strategy will not work. And this is, I think, one of the main problems that a lot of traders face, is that they try to trade their charts all the time, but then often they trade a chart that is not fully aligned with their trading strategy. So really make sure that in step 1 that you are able to distinguish between trending and ranging markets. And in step 2, we are going to take this one step further, because if you are a trend trader like me, we also need to distinguish between medium, early or late trending markets. But for now, step number 1, and this is how I always start my analysis, I will only look for trending markets and I will sort out all the ranging markets. And this should become pretty clear when you look at a chart. When you pull up a chart, you should be able to see, is the market in a trend or a range right away. So here we have a nice looking trending chart, and you could use, for example, a trend line like we have here. If the market is trading within a trend line, then you are looking at a healthy trending market. And this is very important. You can distinguish between the first one here, a trend, or right now the market is in a range. So first of all, the market was in a trend, then it transitioned into a range. This is a very important finding, as we will see later. Here we have a different stage. The market is in a trend, but it's in a mature trend. It's already has been trading for quite a while. And the implications, as we will see in a moment, are very different from looking at a market that is in an early trend, a medium trend, or a late trend. Or do we have something like this? This is obviously a wide-ranging market. And if you are a trend trader, you need to stay away from such markets. I see a lot of traders that they just get involved in any type of market, and this is obviously a problem. Usually, when you have a trading strategy, it's either adapted for a range or for a trend. But you will not have a trading strategy that trades both ranges and trends. So you need to be sure in step number 1 that you are able to distinguish between trending and ranging markets. So now we know that we need to sort out ranges if we are not range traders, and we are left with only trends. That's good, but there's a huge difference between a market that is in an early trend, a mid-trend, or a late trending stage. And how we categorize the trend that we are looking at determines what type of trades we are looking for. Are we looking for continuations? Are we looking for pullbacks? Maybe even reversals in a late trend? Or is there nothing that we can trade right now because our strategy is not aligned with the trending stage that the market is currently showing us? So here, for example, we have been in a long trending market, and if you are a trend following trader, right now is probably not the best time to look for continuations, because in a trending market, if you are a trend following trader, you usually prefer to trade medium or early trending phases. So if you are a trend following trader and the trend has already been going on for a long time, usually the chances that the trend will continue are much lower, and then you don't want to join such a trend. We could also use a 50-period moving average to understand the trend structure much better. In my personal experience, the 50-period moving average is an ideal moving average that you can use across all the time frames and across all markets. And I like to use the moving average because it really helps you to understand what type of trend are you looking at. And you can see the market has been trending above the moving average for a long time. And now the market has even broken below the moving average. So as I said in the beginning, now is not the time to look for more continuation trades into the upside. Now is probably more the time to look for reversal trends into a new trending direction. We could also use a trend line, for example. Here we are able to see that there's a trend line. Early on, when you just are discovering a new trend line, then it's time to look for continuation trades into the trend direction. But as the market is retesting the trend line 3, 4, 5 times, the significance of such a trend line is reduced, and the likelihood that the market is actually gonna break a trend line are increased. And you can see now we are looking at a uptrend that seems to be turning over. We had a double top, and now we are breaking through a last low. When you see that the market is changing from higher highs and higher lows to lower highs and lower lows, this is often the sign that a new trend may be emerging. So if you are an early trend following trader or trade reversals, now is the time to go for a new opportunity. If you are a trend following trader, usually you want to wait out a little bit longer. For example, you want to find something like this, where the market has just recently changed the trend direction. The market traded below the moving average and then broke above it. So whenever you see something like that, that's a good sign that the trend structure is changing, the trending phase. So you go from a late trend, from a mature trend, to a new trend early on. And then if you are a trend following trader, you generally want to wait for the first consolidation. The first consolidation is then providing great trend following entries. So for trend following traders, you can see there's a huge difference compared to late trend traders or even reversal traders. And here you can see we are again looking at a late trending market. So this obviously will completely change the way you approach a market. So if you are a trend following trader, now is probably not the time that you're going to look for buying opportunities. You are probably going to stand out and wait for the market to turn around and change into a new market direction. And by the way, if you want to learn more about this type of trading, as I said, I'm a trend trader. So I trade new trends, reversals, and trend following. Then I've put together a huge special. I've compiled 4 trading courses into a bundle, and I offer it for the price of 1 course. So you get 4 courses for the price of 1. And I've included all my rules for entries, for finding the best trades, how to do a proper multi-time frame analysis. I give you rules for exits, for stops, for weekend trading, for overnight holding. I also included the 3 bonus courses for supply and demand, the daily bias, and if you are new to trading, there's a Forex starter course included. And if you want to take this to a new level, then we also have a Forex mentoring group. So in the mentoring program, you also get access to all of my courses, plus a few special courses such as trading psychology. We have a trading chat room that is open 24/7, and we hold 5, 6, 7 live webinars every single week where we show what we trade, how we trade it. If you are a student, then you can send us your trades and we're going to review them, provide very personalized feedback, and you're just going to be part of a great traders community. And the link to all of that are in the video description or also in the comments, so make sure to check that out. So we already know quite a bit in our first 2 steps from the checklist, and now we are at point number 3, and here we're going to take a look at the volatility of the market. And the volatility generally means how much noise there is, how messy a market is, and how much a market swings. And when we look at volatilities, we can distinguish between low, medium, or high volatility markets. And the way the volatility is showing on your charts, it really determines the tradability. So this means that if you have a huge volatility market and the market is just very noisy, very messy, generally what I do in my trading, I try to avoid those markets because first of all, they're harder to predict, and second, you are going to be the victim of volatility spikes. So the market just makes spikes suddenly in your stop loss, and then you're taken out, and this is very unpredictable. And second, the level of volatility also determines your stop loss size. So a low volatility market generally means that your stop loss may be a little bit more narrow, whereas a high volatility market requires a much larger stop loss so that you can deal with the uncertainty in the markets. So this is what low volatility looks like. You can see the market is moving quite orderly. We have small wicks. There are occasionally maybe a wick or 2 that are a little bit larger, but by and large, the candlestick wicks are relatively small. You don't see a lot of noise. So this is what is considered a low volatility market. Compare that to a medium volatility market. When we zoom in here, you can see that we do have occasionally and much more frequently actually wicks on our candlesticks, and it's more important to look at the most recent price history. How much is the market swinging? Do we have large candlesticks? Do we have small candlesticks? Are the wicks generally large or small? And such a market, then if you decide to trade such a market, generally you want to add a little bit of extra room to your stop loss compared to a market here. Here you could get away with having a more tighter stop loss, whereas here you generally definitely need a more wider stop loss to just be able to deal with the uncertainty and the volatility, so you're not immediately kicked out of your trade. And here you would have a high volatility market. You can see we have large wicks in both directions, a lot of back and forth. The market is really swinging here, and those markets are generally, if you want to trade those, first of all, have a much wider stop loss, and also maybe consider avoiding such markets, because timing a high volatility market is much harder, because the market is just much more unpredictable than it is generally. Here we have a high volatility and a no trending market. So two things that you don't want to see at the same time. We have a lot of noise, we have a lot of volatility, lots of movements in both directions, very unpredictable, and then there's even not a trend. So if you are a trend trader, this is the last thing that you want to see. And whenever you see such a chart, what I would recommend, forget about it, put it aside, don't look at it for another day, for another 2 days, depending on the time frame, and then come back and reevaluate, has the conditions of the price action improved, yes or no, and then you can reconsider trading such a market or not. So the first 3 steps are more about making sure that we have a chart that generally can be traded with our strategy. Now we're going to take a look at a little bit at a deeper level, and now point 4, we're going to draw key levels on our charts, and there can be many things that can be done wrong actually, and a lot of traders eventually find themselves with charts that are completely cluttered with support and resistance, trend lines, moving averages, Fibonacci, supply and demand zones, and then what they experience is a state of paralysis by analysis. So they have so much on their charts that they don't really know what to do. They're completely freezing. They believe that at every line that they drew, the market is going to bounce, and then obviously they don't know how to approach their charts. So I have a few tips for you to do that. First of all, I would always reduce the amount of levels and drawings that you have to 4. What I do in my trading is I try to find two levels that are below the current price and 2 levels that are above the current price, and that's it. I try to focus on the biggest levels, the most important ones, and I have seen that this works really well. You end up with charts that are not overloaded, and you can still perform a nice analysis. You're not always fearful that every little market, every little level that you draw is going to cause a huge problem. So reduce it to 4 levels that you find. And then you can also add a trend line, 1 trend line above, 1 trend line below the current price action. What I would recommend, look for zones, the most important zones. Where has the market previously shown a reaction, support, resistance? Trend lines are very important. Recent swing highs and lows, recent levels where the market has performed a flip. So as we've seen here, resistance is turning into support. That's a very important finding, because it helps us understand the trend structure. If resistance turns into support, generally it means that the market is in an uptrend, and then you have a very nicely organized chart that is not completely cluttered and it's still tradable. I also like to add a Fibonacci to my chart whenever I can find one. So when I am in a trending market, I try to find the first Fibonacci from the top to the first end of the trend wave. Then you can see we have our first retracement, and this will really help me understand the market situation. Are we in a late trend? So if the market has already passed the 161 and is close to the 200, I will be a little bit more cautious with trend following opportunities, because a market that has already passed 161 and is close to 200 has a much lower likelihood to keep trending. Generally, what you will see is after the market hits 161, especially 200, usually trends are likely to end. And this is a very important finding, obviously. Of course, we also need to take a look at our higher time frame. It's very important that before you get into a trade, you check your higher time frame and you want to look for general trends. What is the trending phase, the stage, what are obstacles, and generally you want to have a nice overview with your higher time frame analysis. So here we have on the left hand side the lower time frame that we have drawn up previously. We have a trend line, we have our 4 levels that we have drawn, and generally we can get a good idea, but unless we have taken a look at the higher time frame here on the right, we don't fully understand what is the actual situation here. And what we can see is that the market broke above the moving average for the first time and seems to be retesting the moving average here on the higher time frame. Again, this is the 50, and you can use it across all the time frames. So it does make a lot of sense to look for buying opportunities. It doesn't make a lot of sense either on the higher or the lower time frame to look for shorts, because obviously on the higher time frame you really don't want to trade short when you are above the 50 period moving average. And also on the lower time frame here on the left, we can see we don't want to trade short because the market has already been trading lower for a long time, and the market has just broken above a trend line. So 2 things that really speak against a short market. Here another example, on the higher time frame we can see the market is in a very overextended trend. So the market has broken below the moving average, and since the break the market has not retested the moving average, and also it has traded far away from it. And this is a Forex chart, and Forex is generally considered a mean reverting market. What means is that the market will eventually always return back to the moving average. And the longer the market has spent away from the moving average, the higher the likelihood that the market may reverse. So now it doesn't make a lot of sense to look for shorting opportunities on the higher time frame, right? And when we go to the lower time frame, it also doesn't make a lot of sense to look for shorts because the market has been trending down for so long. And the longer a trend continues, especially in Forex, the lower the likelihood that you will see a continuation. And rather what you could do is look for reversal trades into the moving average on the higher time frame. And for that you couldn't come up with trading plans on the lower time frame. For example, we could draw here a trend line, or we could wait for the market to break a significant previous high so that previous resistance turns into support. And this is how you could then create trading plans. Another example here, on the higher time frame, we can see that the market is about to reach a significant previous resistance level. So here we have a resistance level that has previously twice led to a sell-off. And you can see the market has now been in a very long trending market. So again, does it make sense on the higher time frame to go long right underneath a previous resistance level? Probably not. So this is again how a higher time frame could help you to filter between markets where a buying trade makes sense, a buying trade doesn't make sense, and so you can integrate higher and lower time frames very nicely. All right, so now point number 6 is where we get into our exit plan. So it's very important that before you hit the buy button or the sell button and before you're in a trade, you actually think about the exit, because there's this very nice trading quote: the last moment of objectivity is before you're in a trade. And once you're in a trade, once the money is actually on the line, once you see your P&L go up and down, then very often we cannot act rationally anymore. And we need to make sure that we have our exit plan before we get into a trade. So in an exit plan, you want to take a look at your take profit. Where are you in? Where are you out? What is the reward to risk ratio? Where do you manually exit a trade? Maybe scale in and out. And you also want to ask yourself, does the trade have enough room? Do I actually have enough profit potential here? And are there any obstacles? So let's take a look. So first of all, you want, after you've drawn your levels, you want to understand, is there enough room for my trade to go, or am I immediately hitting big support and resistance levels that could cause problems? So here, if we zoom in, you can see the market is in a trending market. We have a nice consolidation flag. We're going with the trend. And when we look left, we have our first major level right here. Previous support turns into resistance and was a resistance level here as well. So there is a resistance level, but we do have a little bit of wiggle room here. If the market goes up and reaches the level, we have some room that we can then use for managing our trades. We could, for example, move our stop loss a little bit closer so that if the market bounces here, we don't have a full risk exposure. So that's good. We have seemingly enough room here to the upside. We also have a few nice places where we can hide our stop loss. So we could hide our stop loss very nicely here below all of this cluster. And then we have a very nicely protected stop loss. So that's good. It's a good starting point. We can also draw a Fibonacci, for example, for our targets. So we draw our Fibonacci from here to here. We have a perfect Fibonacci retracement. This makes the Fibonacci great and really reliable. And then you can see we have a few options. Generally, what I would always recommend, a target somewhere between 138, 161. And it does make a lot of sense to think about the 161 here because it's right underneath the previous supply and demand zone. So this is a hugely very important supply and demand zone that the market is in. This is the starting point of this downtrend, and there's a high likelihood that the market is going to react again to this level. So your ultimate target should be probably considered well below this zone, maybe here around the 161. That would be a target that makes a lot of sense in this context. And you could use the other levels, the other Fibonacci levels, the other previous support and resistance levels as intermediate exits. So you could, for example, think about scaling out of your trade as we hit the levels. And you can see if we put our stop loss below this zone, it's very nicely protected. The market would have to break the trend lines, the previous support level, and also the Fibonacci. So if the market hits the stop loss, I would be okay with being out of the trade because this is a huge sign and it's a very strong bearish sign actually. So that's a good place for a stop loss. And if we decide our target here below the 161, that's also good. So the target and the reward to risk ratio is big enough. And in my trading, what I do is I have a minimum allowed reward to risk ratio. If I cannot get a reward to risk ratio of at least 2 to 1, I will not take the trade. And this is going to help you improve the expectancy of your trading system significantly. And you can see we can then use, as the trend progresses, the different Fibonacci support and resistance levels to think about scaling out of the trade and you could also think about trading your stop loss. So you could trail your stop loss behind the market. You could think about scaling out at the various important support resistance levels. And then you can see the market would have eventually kept going, but obviously you want to make sure that you have a good approach for the long term. So long term, you will often end up seeing bounces here. So long term, it's always good to not be too greedy, get out what the market is offering you on a reasonable approach, and then your trading may improve significantly. So point number 7, you really want to make sure that you check your news calendar before you're in the trade so that you know what is coming up. And when you trade Forex, for example, I would always recommend the forexfactory.com calendar because here you very nicely see a distinction between high impact news, medium impact news, and low impact news. And high impact news are here marked in red, medium in orange, and low in yellow. And the impact level tells you how much volatility can you expect when the news is released. Obviously, there are going to be exceptions and sometimes this won't really perfectly align, but it gives you a great understanding of there are big impact news coming up for the US dollar. I am about to take the Euro US dollar trade. What does this mean? Do I really want to be in the trade when there's a huge news event coming up? Or do I maybe reduce my position size so that I can reduce also my risk level? But it's very important that you also always check the news calendar. What I really recommend is that you always look at your last 5 to 10 trades before you start your trading day. This is going to be very helpful because it helps you understand where are you coming from? Are you in a winning streak? Are you in a losing streak? And this is a very important finding actually because traders who are in a winning streak, they may be overconfident and they may be more likely to actually break their rules or take too much risk because they think they are invincible. And very often this happens actually unconsciously. You know that you have been trading very well, you are in a good position, and then you're going to become a little bit more reckless. Or on the other hand, if you're on a losing streak, you may be too fearful, and even though you see a good chart and you see a good trade, you are too scared to pull the trigger. Or the other extreme is that if you're in a losing streak, you are increasing your risk and you want to make back your profits and you want to get back to break even. That could also be an implication. Or you find that you have generally in the last 10, 15 trades, 5 trades, whatever, repeated bad trading behavior. I will go back to that in a moment. And the best way to do that is have a trading journal. And obviously at Tradeciety, we also developed edgewonk.com. Edgewonk is a trading journal that you can use for Forex, futures, stocks, cryptocurrencies, commodities, CFD trading. And it is a very popular journal. And the best thing about it is that it visualizes your level of discipline and your level of emotional trading. So we have something that we call the tilt meter, and you can immediately see what is your tilt meter. Is it green? That's good. Is it red? Not so good. And then you can really nicely follow your trades over the last few weeks, few days, few hours. And also, you want to check your trading behavior. Have you repeatedly broken your rules? Have you been not so good with your trading discipline? Have you been breaking your rules? And in Edgewonk, there is the so-called efficiency graph. Efficiency graph measures how well are you respecting your rules. And it's very unlikely that you're going to 100% respect your rules, but if you're a new trader, you want to either see a gradual improvement in your efficiency, or you want to make sure that your efficiency generally is in a high level, and you want to avoid seeing such dips, because the dips obviously mean that you have broken your rules more than what you have done previously. So this is something that you want to check in the morning or at the beginning of your trading week, so that you can understand, where am I currently? What is the current level of my trading behavior? Am I trading at a very high level, or do I need to be extra careful that I don't fall into previous mistakes? And with that, I also want to talk about point number 10, the personal life. You really want to make sure that your personal life is in order and it's not interfering with your trading. So you want to ask yourself, do I have a lot of stress in my daily life? Maybe you had an argument with your coworker, with your boss. Maybe there's a problem financially that is weighing heavily on you. Maybe you haven't been taking care about your health right now. You haven't slept enough. And those are all things that will impact your trading as well. You may not be as focused, you may be very sloppy, you may assess risk in a wrong way and then take too much risk. So you really want to make sure and ask yourself in the morning before you start your trading, am I really in the right state of mind to really trade my hard-earned money? That's very important, and you have to be honest with yourself and don't try to play it down. I've seen it many times. Your situation, your mental situation immediately correlates with your trading results. So be open for it and really be honest with yourself. And then that's it. Those are the 10 steps. I hope you enjoyed it. Again, if you want to take this to a whole another level, make sure to check the links in the video description for my special trading courses, for our mentoring group. And if you have any questions, leave it in the comments below as well.